Hello, everyone. Welcome for another market update call to action from Fratarcangeli Wealth Management and the leveraging of our network. Before I get into the network that we're going to leverage today, a little bit about FWM. Fratarcangeli Wealth Management's been in practice for 31 years, having worked for different wirehouses for the first half and having gone independent for the second half, but yet still utilizing Wells Fargo's custodialship platform, banking, not to mention some other custodians, and ability for us to build best-in-class solutions, ranging from investments, which we do daily and we'll be talking about, to benefits, including 401ks and property and casualty, to mortgages, not just with Wells Fargo, but with many of the top best-in-class options, banks, et cetera, to everything financially, including tax planning, estate planning, and really the full gamut of needs that whether you are aware of or they're in your blind spot that you're going to need to focus on as a business or as an individual or a family, that you need to get guided counsel and good partners to be a part of your team. And Fratarcangeli Wealth Management is comprised of roughly 40 professionals with over 30 years of experience. And I'm so honored and proud of my team for the fact that we've been ranked #1 in the state of Michigan over the last 7 years. And we've been in the top 50 for roughly 7 years and counting in the industry, ranked by Forbes as well as Barron's at times as well. And our goal is to be best in class, guiding and counseling and protecting our clients. The 3 decisions and key components that drive our guidance is based on protecting our clients, growing their assets at a predetermined pace, and keeping as much in the family as well as in the current year as possible, using those 3 components to guide and essentially think about as we guide and make recommendations day to day in the markets and other aspects of the financial picture. That being said, having been in this business for over 30 years, getting to know some really cool and influential and very smart people, I tend to call upon the gentleman I'm going to introduce here in a moment, Gene Peroni, and the Peroni growth strategy and the methodology that's been around for over 45 years, plus 2 generations, that analyzes market trends, identifying opportunities, and helping investors navigating challenging market environments. And we've used Gene and Peroni to build our own strategy as well, leveraging his brain. He's one of the gentlemen that I call upon when I see some questionable, or call it forks in the road, in the economy and the markets or whatever. And here we are today with one of those concerns, and I'd say timely conversations. When I scheduled this, the market was down 4 out of 5 days, double digit, call it 5% on the S&P and close to 10% on the NASDAQ. And then as soon as I scheduled it, Gene, it's like you knew, the market came storming back on the news of Iran and some of the earnings that we saw and some other components that I think we'll talk more about today. But here we are today. We're in an election year, a midterm election year, mind you, which we know that historically whoever's in power, Republicans or Democrats, usually loses power to some degree, if not fully, 90% or plus. And the uncertainty that brings, the unknown, and that's what the market doesn't do well with, is not knowing clearly what's coming. And we have a number of those things happening right now. Kevin Warsh is speaking this afternoon. I imagine he'll lose some of his attendees because of this interview. But that being said, he's going to talk about where he thinks the interest rates and where the economy is going. There's some concerns there I'm going to leverage you for. We've also had some IPOs, initial public offerings, some M&A, as we call it, with SpaceX coming out last Thursday and Anthropic coming next, and kind of getting your brain tuned into what we should be considering, where this market's going, how this election is going to affect us. My first question is timely in the fact that Kevin Warsh is going to be polarizing not only today, but going forward with the change from Jerome Powell to Kevin Warsh. What is the probability and what is the chances that we're going to see a potential rate reduction or some type of a change in rates, both positive or negative? And what are you looking for, and how is it going to affect the markets near term? If you don't mind, Gene, to start us off.
Well, that's a great lead question, Jeff. And I think the answer to that is I don't think there's going to be any significant rumble or big awakening or change with respect to the new Fed Chairman Warsh. I think it'll probably be pretty much a smooth transition. The Fed, I think, will continue to be focused on inflation. It seems to be very hyper-focused on the employment data. Maybe he'll change that up a little bit and look at some other metrics as well. But I don't think that this is going to change the outlook necessarily for interest rates. there seems to be a bit more chatter that there could be actually some rate hikes, maybe many as two, before the end of this year. Whatever the case might be, I don't think it's going to have a negative impact on the market if that is the case. And the market, I think, would not be opposed to doing battle with inflation to keep it at relatively tame levels. My one concern with the new Fed chairman is that there seems to be some indication that he's not going to be as chatty as Jerome Powell was, which is not necessarily a bad thing. But the dot plot might go away. And the dot plot was a graph or a representation of what the Fed governors, what the policymakers were thinking and predicting going forward. Now, analysts like to see that. Investors like to see that. It was kind of a transparency that had not existed before the Ben Bernanke era, and it was instituted by Bernanke immediately following the financial crisis of 2007, 2008. And I think monetary transparency is very important. So this is the little flag that I think we'll have to watch, probably more important than what the near-term direction of rates might be one way or another. But I don't think rates are going to interfere with the basic uptrend, which to me looks very much intact.
Gene, can you hear me?
I hear you well.
Great. I had you on mute inadvertently. Let me ask you this: with the oil prices coming down to the 70s and potentially lower, and on the heels of this deal that was docu-signed, at least on a preliminary basis, and hopefully being signed permanently on Friday in Switzerland by our president and the leader, whoever that is in Iran, with oil potentially coming lower, and we're watching that 10-year interest rate, which is in a direct correlation to the Fed lowering, call it the Fed fund or the short-term rates. How can oil prices dropping potentially or inversely higher impact inflation in your opinion, and maybe as well your projection on the overall economy?
Well, oil prices have certainly had an impact on inflation, but again, it would really be a question of the duration of higher oil prices, whether they get down to a more historically median level here, or if they remain at relatively lofty levels. And it's still a very reactive market. So, as far as the energy sector is concerned as an investment, I wouldn't abandon ship simply because there seems to be a peace agreement at hand. I think the energy category is a good longer-term investment opportunity. So, I don't really have any particular stance with respect to energy and inflation, in particular, how that would impact the market in a negative way. I don't think that it will. I mean, even with rates at higher levels, it was interesting to see that some of the fuel-sensitive areas, especially the truckers, you had a number of the trucker stocks making new all-time highs when oil was near its recent high. And I found that extraordinary. So the economy seems to be quite durable and elastic here, and that's being fully reflected by the market, not just recently, but over a longer stretch of time.
Well, you kind of answered my next follow-up question, but the fact that the market is so resilient in any environment, I mean, we've had such a shock relative to the Middle East, and not to mention the factors that were impacted, including oil and interest rates. And, that being said, here we are with the election. Why is this market so resilient today relative to history? I've been doing this 30 years. I know I've dealt with certain environments where the market's been on the uptrend, late 90s being one. Why are we so opportunistically on the uprise in light of not only the factors you've mentioned, but also the election coming in November? And let me just remind you that the market historically in that midterm election year is the least rewarding. And we're sitting here today with high single-digit returns on the S&P specific and the Dow somewhere in that middle range, which is considerably higher than the average. Why do you suggest that this market seems to be more opportunistic? And is it a sign that we're maybe getting too ahead of ourselves, or do you see more positive to come?
Well, there are only two things that really matter to the stock market at the end of the day, and that is interest rates and earnings. And with a more transparent Fed monetary policy, that kind of reduces interest rates as a key factor here, because up until now, at least, the Fed has been telegraphing its moves well in advance. So the market has had plenty of time to absorb, contemplate whatever the Fed's next move might be with rates up or down. So, in as much as it might blunt the impact of higher rates, it's probably taking away some of the impact that lower rates might usually have had.
Hmm.
Importantly, earnings are continuing to grow here at a very substantial rate. And the earnings comparisons relative to Wall Street forecasts continues to be stunning. In the first quarter, among the S&P 500 companies, 84, I believe it's 84% of the companies reporting have beaten expectations, earnings expectations. 81% have beaten the revenue forecast. So this is extraordinary, especially at a time when in the preceding months, if not the preceding year, economists have been warning time again of recession and stagflation, and it's just not showing up in corporate America or on Main Street America for that matter either. I mean, look at these consumer discretionary stocks are doing really well. So I think in the end, Jeff, this market is telegraphing something quite strong on the horizon. And it is very easy to get caught up in the noise, the daily news, certainly the geopolitical events, the Fed, and so on. There are so many things, certainly social events, political banter, all these things. I think more or less, not entirely, I don't want to dismiss them out of hand, but they can act as more distractions than indications of what's to come next, not just for the stock market, but for the economy. I think the stock market has been a great barometer of the economic outlook.
Listen, my audience and those that will be watching this on the retape, two things that I heard from Gene, maybe more than two, but in specific, interest rates and earnings are the key catalyst to the market. And the third thing you said was don't get distracted by the noise. And I wonder, I'm going to follow up a light question before I get into my more definitive question in that. I know that Kevin Warsh has made indications that he's not going to be as transparent. And I don't know what that means. None of us do. And we're going to be watching his comments here shortly. And yet, Jerome Powell, the previous Fed chair, was very vocal. Matter of fact, last week, Gene, he came out and made a very strong comment about a recession and a market correction. And listen, my feeling is your job is to indicate what we should do with inflation. Where did it become their job to tell us what the market's going to do? And I think maybe, just maybe, Kevin Warsh was commenting on the fact that he's not going to do that. He's going to maybe be transparent on rates, but not necessarily. I just don't know what Jerome's Powell, the taken out of context comment that we've heard, at least I have, how that relates. Could it relate? And what are the odds of that, in your opinion, being what Kevin Warsh meant by not being, as you call it, transparent in the dot comment you made about how he indicates where they're going to go next with not only liquidity, but interest rates?
Well, I think with respect to Fed commentary, what Kevin Warsh is trying to avoid is getting locked in a box. In other words, if he comes out and says, oh, I think, the economy's heading toward recession, and then the Fed does something completely counterintuitive in terms of their next rate move or next monetary policy statement, then that would not be good. My concern is really more toward that dot plot, because I think that's something that really should continue to be propagated. But no, I think we have to wait and see, obviously. But I think what Kevin Warsh was getting at is just as you say that the Fed doesn't want to get into a political stance here, and they don't want to put on too much of an economic hat, especially if it eventually proves to be contrary to what the future moves are with respect to monetary policy. So that's probably what he's getting at.
He doesn't want to misguide people. Listen, Jane, I'm asking for a friend. What is this dot plot? Can you explain?
Yeah, the dot plot is simply a representation of what the Fed governors, what the policymakers at the Fed are forecasting going forward as far as what the next likely moves are
Percentage
for interest rates and so on. So it kind of gives a graphical representation, if you will, of what lies ahead for Fed policy. So it's not a matter of we have to wait and see what the next meeting brings. it kind of gives a little bit of a forward think, a forward look. So I think that's a good thing for the Fed to continue to do that.
Okay, thank you very much. I will let my friend know. That being said, what sectors do you think will lead? The technology sector, obviously, most recently in the last few trading days, not to mention the last couple of years. I find it interesting that Magnificent Seven, which has led the market the last several years, is now no longer leading the market, but yet tech is still. Do you still think tech will be the leader? And if so, what are the indicators we'll watch for and what's the upside? Furthermore, what lagging sectors or maybe other sectors that we should watch that should be opportunistic?
Well, I think that tech will be a leader. Um, the thing with tech now is that there are some tech stocks that are obviously doing very well, especially some of the semiconductors, while some of the softwares are mixed, and some of the other related tech stocks are a little bit mixed. As a group, of course, it's doing very well with the Nasdaq leading the other major indices year to date, but not making a new high, as has the Dow Jones Industrial Average. So I find that encouraging. I think this is a different market and begin to become a different market back in October of last year. That's when we saw some lagging sectors. I'm talking about sectors that lagged for years beginning to improve, and they've been doing so steadily. So agriculture, aerospace, defense, metals and materials, a number of the industrial names, financials, consumer discretionary. You can go down a pretty good list. I think the takeaway theme in terms of where the core leadership is, though, is infrastructure. Yes, roads, bridges, tunnels. So the industrial metals and materials, the agricultural materials, the obviously the industrials, the heavy machinery, the traditional manufacturers, the specialty alloys. I mean, go down the whole list. Industrials include such a broad number of subcategories. I don't know why the S&P is not breaking down this particular category. So the industrials, I think, are still a very key category. Uh, all this noise, by the way, is the Fed news that they're leaving rates unchanged. Financials, as I mentioned, they look very good. Not just the big banks. What I like here is that the regionals are coming along well, and the insurers are holding their own. Um, and I mentioned a consumer discretionary group. So, here's a point where oil is going up or had been going up. There was a lot of worry about inflation. There's some worry about the political landscape. It's not affecting the consumer, especially looking at these brick and mortar retailers. They're trading near their 52-week highs. So this is very encouraging from that standpoint. The other category that has more recently picked up in terms of more attention, more recognition, is healthcare. And healthcare, which has been a long-term leader in this market, went through quite a long lapse of leadership over the last couple of years, partly due to the fact that technology was taking a lot of the oxygen out of the room, partly because of the uncertainty as to what Trump administration health care policies would be, and so on. All that, in my opinion, has been fully baked in to this category. Biotech still look very interesting here. The life sciences that had been underperforming, the medical devices that had been underperforming, the drug distribution group that had been underperforming, they're all starting to really turn the corner nicely. Big pharma's looking attractive here as well. So I think healthcare is going to regain its leadership stature, and I do think that it is an important allocation to a strategically diversified portfolio.
It's interesting. You've mentioned quite a few sectors or subsectors in that technology still being in the game, but yet a transition and a rotation, as we like to call it, into other areas as well, kind of backfilling. Agriculture, defense, metals and materials, industrials, financials, consumer discretionary. I've had the benefit and really true honor to be a part of the RV industry. And I don't know that you can help with this question, but I'm going to try anyway. They've been feeling some pain. And that is a discretionary sector, as we know. And there's a number of factors that could play into it, including the fact that they had such a high demand during COVID and the high overbuilt, call it market at that time. And then the secondary market sort of falling into place when everyone started traveling call it overseas, and then the RV industry demand, or I should say the need for these RVs has dropped. But we've had elongated scenario, and I'm seeing about a 15 to 25% drop across new RV purchases. Not sure how familiar you are with it. That's a discretionary sector. It's a leading sector. I can't discount it. I'm curious if you have any opinion or any, let's just talk about kinks in the armor or concerns, or you got your eye on this. And if this happens, I'm a little concerned. What do you see out there for our, glass half full folks out there?
Well, I think that I'll comment on the RV category very broadly. And that is to say that another category, and it's within consumer discretionary, is leisure time. I mean, I'm looking at a number of leisure time stocks, from recreational vehicles to cruise lines. They are all shaping up very nicely. To what extent that bodes well for the RV sector. I mean, I'd have to think that they would, catch some of that stream, or that improving stream of interest. So, as a category, I think I would probably investigate opportunistically, but importantly, it looks like its representative peer group is improving, and that's what we like to see when we're putting together any kind of a model. Is if we like a particular stock, we want to make sure that other stocks within the peer group also look attractive. And so I think, a case can probably be developed in that regard with respect to the RV category at this point. Probably quite oversold, especially in view of the most recent worries about fuel costs and inflation and so on.
Interesting. Be patient out there in Elkhart, Indiana. Good times to come. And remember, the market is a 9-month indicator to where we're going, not necessarily where we're at. So be patient. I wouldn't be surprised what you say is accurate. Having been around that industry for 20 plus years, I say their time is due. What other sectors or sleepless considerations are out there? And when we listen, the last time everything was perfect, Gene, I haven't witnessed. And the day it happens, I'm selling all my stock. Tell me what we have to be concerned about.
Well, you still have to be concerned about the Fed and interest rates and anything that would impact interest rates adversely. There's already chatter, as I mentioned, that there is a possibility, if not a likelihood, that interest rates could move up later this year. So that's not going to be a big shock to the market if indeed it happens. And I would probably say that if it did happen, the market would be streaming along pretty nicely. Remember, the market thrives in an inflationary environment. The only thing it doesn't like about inflation is when the Fed becomes overly aggressive and tries to combat that inflation. But inflation is particularly good for cyclicals, and this market is being very significantly, if not substantially, driven by traditional cyclical categories. If I could just mention one aside, because a lot of the basic industry is doing well, basic materials are doing well. I think it's interesting to regard the Dow theory. The Dow theory was created by Charles Dow many years ago when the Dow Jones Transports was referred to as the Dow Jones Rails. And Charles Dow argued that if the rails are leading the industrials, the Dow Jones Rails are leading the Dow Jones Industrials higher, that is a very good sign for the outlook for the stock market and for the economy as well. In other words, it's a sensitive indicator that you're seeing early positive traffic on the rails. So this has to mean that more commodities, more goods are flowing, and this is going to eventually be reflected in the industrials and other areas of the market. There are times when it doesn't apply. It's a talking point, but I think it's a pretty interesting one. I mean, just look at the difference here year to date. The Dow Jones Transports are up over 24% year to date. That compares with the Dow up less than 8%. One other thing I didn't bring up, and this is a totally separate subject, is the difference between the S&P 500, as you pointed out, up about, 9%, and the S&P 400 Midcap Index. And this is something else that developed after October. The mid-cap and small-cap stocks are outperforming here. And they're not doing it just short-term, in my opinion. They're doing it for the long haul. So the S&P 400 Midcap Index is up over 14%, with the S&P 500 up about 9%. That's a big difference. And this is something I predicted last year, and I think it's going to continue not just through 2026, but very possibly into 2027 and even beyond. What's important about that? Well, of course, it bodes well for the small and mid caps. But when the small and mid caps are doing well, it means that investors are willing to take more risk for more reward. So they're more confident about the outlook for the economy and certainly the outlook for the stock market as well. It means that the repatriation efforts on the part of the Trump administration in particular are moving along well because small and mid-cap stocks derive a lion's share of their revenues from the North American market. So more companies, services, manufacturing moving back to the U.S. bodes well for the ancillary second level companies that supply to these big companies. So this is an extraordinary time. And again, it just adds another layer of foundation to this advance.
Nice. So the small and mid cap, specifically S&P domestic markets, have been really lagging, and here we are since October seeing that's outperforming, and that is a very good sign of a broader bull market, and that means the market is backfilling and continuing to move higher as a large unit versus one sector, one group of companies sort of carrying the load. That's very good. And then I'm going to talk about this later, but it's called diversification. Don't chase what's already gone up. Make sure you have a balanced portfolio, because if you moved into the Mag 7, like we all talked about, year over year for 3 years consecutively, you're flat for the year. So that's not a good result when you have the S&P 400 up double digits, and not to mention the transports up over 20%, which you didn't see prior to October. So good takeaway there. I have to ask you, does the tariffs that we've been talking about since last February and back and forth with the new laws and, call it reversal, how does that affect the markets? And do you anticipate that playing any role going forward when we get past this Iran scenario, hopefully by Friday?
Well, that's probably out of my wheelhouse to answer directly. But again, from what I'm seeing in the market, uh, I don't think it's going to have a great impact, a great adverse impact on the market. I would think that once the Supreme Court ruled on that, that we would have had, the knee-jerk reaction, a very substantial knee-jerk reaction, and we just didn't get it. So I'm not sure that we're going to get it going forward. I think there's going to be such momentum with respect to a number of sectors and themes and the economy overall that it won't be as critical to the market. So no, I don't think that is an overwhelming concern, at least from my point of view. And I don't think the midterms either, for that matter, should be an overwhelming concern for investors.
So hear what he said. He said those tariffs that have caused a great deal of uncertainty in previous quarters, and not to mention recent, just in the last year and a half, you don't see that as being a headwind that's going to cause any type of derail to the upside, coupled with the fact that you don't see the midterm elections coming in November having any major impact. That was going to be one of my questions. Let me ask you about commercial real estate valuations along with the private debt market. Any concerns there? It may not be your wheelhouse, but do you have an opinion?
No, Jeff, that's way out of my area, so I better not take that question.
I'm going to have to dock your pay, Gene, unfortunately. Well, I do think we have to keep our eye on debt. I don't know that we have any major concern there, but I certainly have my eye on it, and we'll do our homework. So thank you for that. I have to ask you, listen, I want to bring a company public that's making no money, and I want it to be worth $2 trillion. How do I do it? Do I hire Elon? What's your thought on SpaceX?
You do it with an extraordinary product or service. And of course, you do it after, quite a bit of publicity and media attention. Uh, that's a good start.
I got to work on that, Gene.
You also do it with a prospect that you are going to earn money and that you are going to have incredible innovations, unlike anything that's come before, and that you're going to have a continued great success with your launches and so on. In this case, that it's an absolutely incredible moment. Now there would be some that would say this is an indication of the top of the market, but no, I don't see that at all. I think it's just an ongoing, extraordinary, exciting moment in market history, but I don't think it's the bell ringer for a major top where there's incredible speculation and so on. But we're not really seeing speculation in the underlying market to any great degree. Even some of these fast-running semiconductor companies, unlike in the late 1990s, most of these companies have earnings, or they're expected to have very strong earnings going forward. So in the case of some of these IPOs, probably the same thing. It's anticipation. When the market's anticipating, it's doing well. When there's too much expectation, that's when it's time to get out.
Yeah, interesting. Well, IPO market, right? Some of the risk on assets hitting the S&P 400, the mid and small caps. Historically, when you have a hot M&A market, you see some of those dollars, and there's 9 trillion of them out there in cash. Last look, start chasing some of those other areas, which may deflate or maybe mitigate some of that upside in the general market. Mind you, the stocks that are going public will end up in the market, so maybe not so much. But how will that impact the markets, and what do you anticipate in the M&A market, and what should we be watching for, Gene?
Well, again, this is only my opinion, but I do think there is going to be more M&A activity, and I think there's going to be focused in some of the previously hot M&A areas, especially healthcare. You have a lot of these big pharmas that are in need of rebuilding their pipelines, and they're doing so to some degree with partnerships with biotech companies. You can see from time to time when these partnerships turn into acquisitions. I would not be surprised if there is considerably more activity in the healthcare group. The aerospace defense category is another one where there's been a great deal of M&A activity over the years. You can look at all the big defense contractors, and I can't think of one that hasn't had some significant M&A activity over the years. So that is another possibility. And look at the aerospace defense category. It is basically a mid-cap category. Yes, there are some large caps in that group, but there are a lot of suppliers and so on that make up the bulk of the aerospace and defense subsector to the industrial. So that could be a ripe area going forward as well. And there are others as well. It could be in the financials. There could be in other industrial areas. This is a time, I think, of heightened competition now as companies repatriate and look to identify their strongest business areas and then build upon them. And some of that can be done organically, but maybe not entirely.
Again, you've covered a lot of ground. You talked about everything from the Fed to interest rates to the market's volatility, the midterms, the tariffs. IPOs, M&A business, the S&P 400, the mid caps and small caps, the resilient market regardless of the noise. We talked about the general outlook being positive. We talked about the Fed being less transparent. You've given me a lot to think about and a lot to consider as we move forward, but I'm going to summarize my sort of thoughts of what we should take from today's call as I sit back and maybe come up with more as I talk to our clients over the coming days. But if you could leave us with your overview of the markets, what you expect this year through, call it December, what you expect next year in light of the earnings growth and the expansion that's explosive. I remind everyone, the earnings not only for the first quarter, but the projections. What do you anticipate this next chapter to be for the market, and is the best yet to come?
Oh, I think the best is still yet to come. But I don't think we're out of the woods near term with respect to volatility and market reactivity. I think we're going to continue to see a good deal of that, at least over the short term. And that's not a bad thing because it keeps speculation in check. It keeps optimism in check, so you don't move to the euphoric stage. I do think, that we are going to finish above these levels. I've got a 53,500 target in the Dow, which I know isn't all that terribly far from where it currently is. It could go a little bit above, but I just want to give kind of a directional guidance there. I think the Nasdaq can go somewhat higher. I think the S&P can go a bit higher here, possibly back somewhat above the highs it's already struck. The real story is going to be stock picking, sector and theme identification for success. So it is going to be important to be strategically diversified and not all eggs in one basket, as you mentioned earlier. Each time I think we're getting close to moving from that optimism stage to the more euphoric stage. Something comes along, obviously, most recently, the Iran war, and that sets the market back and it reins in the bullish sentiment. So that's a good thing. This volatility is good for the long haul.
Agreed.
I just want to say, though, I believe that at some point, the barn door is going to open and the bears are going to capitulate, the bulls are going to stampede, and we're going to see a conclusion to this bull market, unlike the conclusion to any bull market before it in history.
In other words, you're going to have a huge spike and a euphoric upside. Capitulation is when everyone just gives up. In this case, the bears give up and they say, fine, I'm getting in. And that's where the market goes. You have $9 trillion on the sidelines. You have a number of pessimists out there. And I got to tell you, I love pessimism because I know that that means more upside. When I get the phone call from that smart CEO saying, I'm concerned, and then I ask him how his business is going, they say, phenomenal. I say, it's time to buy. So when I get that call from that conservative investor, which I start to see a little bit here and there, saying, I want to go ahead and buy SpaceX that makes no money, that gives me a little concern. So I think there's a little bit of both. My takeaway from you is, one, as my buddy Frank said, the best is yet to come. My takeaway is it's a rotation into other sectors that haven't been as prominent, healthcare being one that I've heard very clearly. I think the next iteration of benefit from AI could be there. Okay. The M&A market could play into that as well. I did not hear
Very
that
true.
prior. Thank you for that. What I heard you say is diversification. You didn't say it, but I heard it. And that means don't chase the hot dot. Not to be confused by the plot dot or the pot lot or whatever you referred to with the Fed's doing that my friend asked about. But the reality is we need to balance out our portfolio, both with the cadence of what's our longest term money that we're going to touch last, all the way to what we'll be needing first. So getting more conservative on what we need next, taking a more growth-oriented or aggressive approach on the money we know we're not going to touch well beyond 5 years and probably 20 plus years like our retirement accounts, and then just realize that whatever money you're going to need within the next 5 years has no business being in the stock market, because as smart as Gene is and as smart as the folks we surround ourselves with, there's always something we don't know. An Iran war, etc. So be patient, be gradual, be intentful, be diversified. And number one, protect. And number two, build towards the long term that you're comfortable knowing that you do have that long-term capability. Here at Fratarcangeli Wealth Management, we're honored to connect with you today, and we're honored to work for you, and we're honored to be in touch with you in near term. And my team and our culture that we've created is all hands on deck, waiting, willing, and available to help in this next turn. And having partners like you, Gene, gives us the strength, the information, and the capability to continue to win. So I appreciate you all. I wish you all the best. Happy Father's Day to all of you out there, including you, Gene. And we'll see you soon.
You as well, Jeff.
Bye for now.